We'll begin the seminar with our guest speaker, Brent Joyce. Brent Joyce is responsible for promoting GLC and communicating the investment philosophies, outlook, and strategies of GLC's investment management divisions, GWL Investment Management, London Capital, Laketon, and Portico. Brent also provides insight into current market and economic conditions to our clients and investment partners across Canada. Brent has over 18 years of financial services and investment management industry experience, having worked previously for CIBC Asset Management, Talvest Mutual Funds, and Royal Bank of Canada. Since May 2008, prior to his current role with GLC, Brent's responsibilities included building and servicing the separately managed account business affiliated with Laketon, now an investment division of GLC, and working closely with the portfolio management teams of Laketon. Brent holds the Personal Financial Planner designation from the Institute of Canadian Bankers. Brent?
Good evening. It was a lovely meal. Well, there's my music. Thanks, Daryl. This audience will recognize this. I spoke to an audience that was half the age of this audience, I suppose, and they didn't have a clue what this music was. So I think everybody here probably recognizes it. The Good, the Bad, and the Ugly is a title that I came up with about 4, 5, 6 months ago, I suppose. And it was born out of looking at a list of investment fund returns. And some of you might be familiar with one of these lists, one of these sheets, or if you look on the internet, you will typically find that the list will start with money market funds, and then you have bond funds, Canadian equity funds, US equity funds, foreign equity funds. And if you look at the 5 or the 7 or the 10-year rates of return on these investments, you will see good and bad and ugly, for sure. Now, what I want to do for the next few minutes is try to convince you that all of these things are useful to have in your portfolio all at the same time. Because if all you have in your portfolio are things that have done really, really well, then I would argue that you don't have enough future opportunity in your portfolio. And certainly it's very painful to simply have things in your portfolio that look ugly. But ugly is a fact of life and a necessity, and usually the birthplace of all things good. So that's where the title came from. My introduction mentioned GLC. That is certainly not a household name. In fact, as a company, we are only 3 years old. Many of you in this room probably have money that's invested with us through Langlois Financial, because we operate under some brands that are much more familiar in the marketplace. Combined, we are $34 billion in assets under management in 3 locations: Winnipeg, London, Ontario, and Toronto, where I make my office. And we do offer a broad range of investment mandates across these brands. London Capital, affiliated with London Life. Great-West Life Investment Management is pretty obvious. That's Great-West Life Insurance Company. Laketon is an investment business where I joined this firm that's affiliated with Canada Life. And Portico is simply our bond people. They didn't have their own name, so we built them one a year and a half ago. So that's who I am and where I come from. I work closely with folks like Langlois Financial, here not only in Ontario, but also in British Columbia and Alberta. And my job is to try and shorten the distance between the men and women who are making the decisions day in and day out on your money, if it's invested with us, and you folks, and folks like Mike and his team, so that you have a greater understanding of what it is that we're up to with your money. So that's the goal for tonight, and a little bit of educating along the way. We're going to do a little bit of math, so I know it's late and there's been some wine and a nice meal, so bear with me. Growing, slowing, and imploding is what this presentation talked about. This inferno, my raging inferno, I had been using for the better part of 2 years until the beginning of this year, and I replaced it with a bit of a smoldering campfire. And this is to represent all of the bad news that certainly the media will remind us of. The media, just as a reminder, is not in business to help you achieve your financial goals. The media is in business to sell newspapers and advertising space. You may be familiar with an old media adage, newspaper adage really. If it bleeds, it leads, right? The car crash, the inferno is always at the front of the news or the front page, and the kitty cat getting rescued is at the back page. Well, now in an environment where we have 24-hour, 7 days a week news, and certainly 24 hours, 7 days a week investment-focused news, these outfits can sometimes find themselves starved for information. So they will belabor points ad nauseum. And that can be very confusing for all of us. So some of the stuff that we certainly are looking at and are worried about, and the world is worried about, gross domestic product, that's economic growth. Right? We'll look at that in some detail. Not only North America, but other parts of the world. It certainly is a global marketplace. And what happens south of our border and across the oceans will impact our investments here. Politics and politicians have been causing headaches, for sure, for both stock markets and bond markets. That is something that, as portfolio managers, we have a difficult time trying to handicap the outcomes of those things. We are not managing your money on a day-to-day basis based on what may or may not come from a Greek politician, right? Or even the dysfunction that we see in Washington. Earlier at the cocktail, I met a fellow, he said, I'm really curious to know what might happen with this U.S. government debt deficit and the ceiling and the shutdown and all that sort of stuff. We can talk a bit about that. But by and large, we're focused on what is happening on Main Street and what people are doing and what businesses are doing, and hopefully the government getting out of our way, as all of us as participants in the economy. But it certainly is something that has been an emphasis and is going to continue to be for a while here. A lot of it has stemmed from this, government debt and deficits all over the globe. Certainly is a problem to be concerned about. What else have we got on here? Budget cuts and austerity go hand in hand with that. One of the ways that we deal with government debt and deficits is through budget cuts and austerity. Austerity simply meaning firing people if you work for the government, cutting back benefits if you're a pensioner in Greece, and you were getting 700 euros a month, now you get 500 euros a month. That's austerity. It's painful for those folks, for sure. Better than 0 euros a month if the government goes bankrupt. Unemployment's an issue, definitely. All these things certainly go hand in hand. Nothing here is really in isolation. And one that's been in the news as of late is this tapering. And tapering has to come with my firefighters. Because the reason we went from a raging inferno to more of a smoldering campfire has been on the part of a piece of our government, central banks, pouring water on these problems. Water in the form of money. And you see many of these acronyms in the media, ESFS, LTRO, QE, Abenomics. Right? All of them really are printing money in order to throw it at the financial system so that we don't suffer through a more prolonged financial crisis than the one that we did. So that has been working. And the tapering comment that I make at the bottom there really is the notion of when are these firefighters going to turn these hoses down and in fact finally shut them off, roll them back up and put them in the truck. And we can get back to business as normal, where the economy, the private part of the economy, what all of us do as consumers and households and what we do as individuals in businesses can get to functioning on its own without this artificial support from governments. So that's a bit of the backdrop of growing, slowing, and imploding, and a few of the themes that we're going to talk about as we go through here. So, gross domestic product. Here's a look at it around the world. And I mentioned good, bad, and ugly, so we had better throw some labels up here. We got the US I've labeled as good, Canada as bad, and the Eurozone as ugly. So the Eurozone's probably not a surprise. When you're shrinking your economy, that is for sure ugly. And they were shrinking, and they've just started to turn the corner. The hope for next year, again, remember when we look at these numbers at the bottom here, it's 2011, we know that, 2012, we know that. 2013 isn't finished yet, so that's got an E beside it. That's an estimate. A best guess of a variety of pundits, what they think may happen. And certainly for 2014, it is an estimate, a best guess. So the ugly moving above 0 is certainly just hope. One of the questions I've had, however, is, well, how come the US at 2.7 is good and Canada at 2.4, it's not that far off, is bad? Well, the risk here is in whether or not these estimates are right. And in our view, the estimate that 2.7 for the US is potentially going to come in a bit higher than 2.7. That would be a good thing, right? We think that that's maybe a better outcome, or more likely outcome. Then when we look at Canada and think 2.4, maybe that's a bit rosy, given the environment and some of the things we're going to talk about in a moment. So that's where those labels come from in terms of good and bad. Neither one is necessarily in aggregate bad, but relative to where expectations sit. And one of the things we have to remind ourselves when we talk about stock markets and bond markets is these are forward-looking animals, right? They're discounting machines. They're trying to predict the future. And it will have a guess as to what that future is going to be. And when that future comes in different, that's when we see equity and bond markets move around quite violently. All right? So missing estimates and missing these guesses is really what the market is focused on. What is GDP? It's actually a fairly simple statistic that's in the media on a quarterly basis. We're going to get numbers for the US and Canada in a number of days here. And if you look up in an economics textbook, you will see that formula, C plus I plus G plus X minus M. Really all that means is you can divide what happens in the borders of a country into 4 buckets. What we do as consumers, as households, right? What we do as businesses, what the government does with money, our tax dollars or borrowed money, right? They're paying wages and buying pens and paper and in the economy. And then whether or not we are selling more to the rest of the world than we're buying from the rest of the world. So it's a fairly nice, neat, tidy compartmentalization of all things in the economy. And everything in the economy goes into one of these buckets, and one of these buckets only. So that's quite handy. So if we're trying to get a sense of whether the economy is growing or not, or how much it may grow, we can break it down and ask, what do we think each of these pieces may do for us? Well, on the consumer front, we would expect that consumers are going to continue to feed and house and clothe themselves, and that we will see some growth from the consumer to contribute to economic progress. Businesses in North America, and in fact, pretty much all over the world, the developed world for sure, are flush with lots and lots of cash. Balance sheets, bank accounts at corporations have nary been fatter than they are as of late. You may recall some of the chastising that our former Bank of Canada governor did before he left to corporate Canada, saying, put that money to work, build something, hire somebody, grow your business. Right? So businesses certainly have an ability to put some resources to work and to grow the economy. The question mark is whether they will do that with vigor. The government, I would say, is maybe, in Canada, probably a 0. And in the US, we know that they're a net detractor from economic growth. They are shrinking, largely because of fiscal constraints, debts and deficits. Some of it is being forced by their inaction and their inability to come up with a budget and to come up with a plan on how they're going to spend money going forward. Right? All that is certainly a disruption and does remove economic activity from GDP. And then everybody would love to sell more to the rest of the world than they buy and to pocket the difference, essentially. For a country like Canada, we all know this is a big chunk of our prosperity. It's certainly a big chunk of something we need to pay attention to. You may recall in Obama's first term, he made this one of his platforms. He wants to see America become an exporting nation again. And there are some signs that in some areas, some industries, that's beginning to happen. Right? As we've seen unions adapt and reduce their wages, and we've had major segments of our economy go through bankruptcy proceedings like the car industry, right? And put them on a new footing. So that's GDP. We'll start in Europe, very briefly. I like this chart because it goes back a long way, and they were telling me how to use the pointer. I'm going to actually see if I can figure it out, Daryl. Here we go. Prior to the launch of the Eurozone, so these go back to 95, 97, 99, this is what it cost European governments to borrow money, these lines, right? It's these interest rates on the side here. And you can see that various countries were treated differently. Greece had to pay more than Germany because they were more risky than Germany. That's fair enough, right? And then after the Eurozone launch, everything comes down to a common denominator. Greece is able to borrow money at the same rate that Germany is able to borrow money. No differentiation. And that would be well and good if the European Union and the Eurozone wasn't a work in progress like it is if it were a finished product. We have to remember that the Eurozone is different from certainly Canada, the US, Japan, even England, in that they have this European Central Bank. And one of the main things about a central bank, one of the first things, job number one for a central bank, is to make sure that the private banks in the country don't collapse. That's how central banks were born, and it's their primary goal. That's why you saw banks being bailed out by the Federal Reserve in the United States. Similarly, you saw banks like Halifax Bank of Scotland and Lloyds Bank being taken over by the UK government, right, through the banking system. That did not exist, and still doesn't exist, in fact, in the European Union, because it's new. Day by day, they're writing the rule book on how to move this economy as a collective 17 countries forward. So what happened in this period here where we saw all these rates diverge again is people realized that when the tide went out, not everybody was wearing a bathing suit. Greece was caught with their pants down. And they had these banks that had lent money outside of Greek borders to other countries in the Eurozone and didn't have the resources to backstop those loans. Right? And this is the problem. As much as it is very distasteful to me as a taxpayer, and I'm sure to many of us in this room, it is very unpalatable to rescue fat cat bankers. And if you listen to my bio, I know what I talk about. I was at a bank for 12 years, CIBC and Royal. Right? They are special. They are the lifeblood and the backbone of all the rest of the functioning of the economy. If you have from bad to ugly, and now we're getting good again, why is that? Well, it's because Mario Draghi, the leader of the European Central Bank, made a statement that says, I am going to save and backstop all of these European banks. And I have the resources to do it, and I have the authority to do it. Neither of those two things actually were true at the time, but people believed him, and things got better. He hasn't actually had to spend one single dollar rescuing a European bank. Simply the promise that he would do it was enough. And that is because the banking system is predicated on a very, very fragile concept. It's predicated on trust. That we don't expect this is going to happen. If we put our money in the bank today, we expect to go back next week and be able to get some of it out. And if we don't have that faith and that trust, banks fail and the rest of the economy goes down with it. Think about just the basic function of clearing checks and processing visa payments, right? Let alone the lending that banks do to households and to businesses. So this is why that they are being treated special, and it's why they were bailed out. Right? But that's history. Certainly it has put the European Union on a path where we can see that ugly GDP number potentially moving into positive territory on the notion that this concern that the banking system was potentially going to fail has been taken off the table, right, by the actions of the central bank. Some good news. Housing in the United States is on the mend, has been for quite a while. Michael shares a lot about his family with clients, and he was telling me that they purchased a condominium in Florida, and he did it at a very good time, a year and a half or so ago, because prices have been rebounding dramatically, particularly in Sunbelt locations like Florida, Phoenix, Southern California, as we can see here. Housing is also very, very critical, particularly to the U.S. economy. Think about it. Housing does a number of good things for us. First of all, as a consumer, what's going to make me go out and spend some money? And remember, consumer is part of what goes into economic growth. It's that C in our GDP equation. Well, if I have a job, I'm going to go spend some money, especially if I think I'm going to keep my job. If I have a home and I feel wealthy because I have a home, that usually spurs me on to go and spend some money. If I'm buying a new home, certainly I spend a ton of money. Anybody who remembers or knows, right? You got to fill it with stuff. So the housing market certainly is important from that standpoint. It's also important as an employer. You don't outsource a lot of the construction of a home. You don't build it in Venezuela and then set it up in Omaha. So it has really big knock-on effects in terms of employment for the U.S. economy. So with the housing market out of the way, right, 3 years doing nothing and shrinking and falling and falling and falling, right, we've now been the better part of 2 years with a recovery in the housing market and we're seeing plenty of the good spin-off benefits that come with it. Not the least of which in Canada is firming pulp and paper prices. Anybody may have noticed forestry stocks, they've gone up twofold in the last year and a half. There aren't that many left that you can invest in Canada, unfortunately. West Fraser Timber and Canfor would be two. Right? These things are skyrocketing off of very low values because of recovery in U.S. housing. Been a lot of talk about Canadian housing, whether we were getting a little bit ahead of ourselves and overheated. And you can see, let's see if I get the pointer out here again. This is where all that talk is coming in. This is where the government started to change some of the rules around mortgage insurance to cool the market off. We saw that effect take place, and we've seen a little bit of a rebound here. A couple of things about Canadian housing. First of all, we think it's in reasonably good shape, right? But we need to understand that it is an average, all the stuff that's typically reported in the media. And if I have one hand in ice water and one hand in boiling water, on average, I'm happy. No, right? I might be on average warm, but I am certainly not happy. And Canadian housing data is a lot like that. We know that it is influenced very significantly by Vancouver, Calgary, Toronto, Montreal. Right? But if you ask somebody in Cornwall, Ontario, whether their house price is in a bubble, they will either laugh at you or punch you in the face. Right? So we need to be careful when we see these numbers. The other thing is that back to the media, you can talk about two things in housing. You can talk about housing starts, you can talk about new listings, you can talk about the number of transactions, and those numbers are wildly large variations. So the number came out yesterday for Vancouver. 35, 40% increase over the previous year in new listings. Prices actually fell by just under 1%. So be careful about what the media is putting up, because the headline will read, housing market 35% up, down, sideways, whatever. Right? We need to understand what is it that they're telling us about. Because listings certainly give you some indication as to sales, but it's not the same thing as sales. And we also need to remember that these markets are going to be moved by 3 or 4 large locations in Canada. On the employment front, so whether I spend money is whether or not I have a job. Certainly the story in Canada has been fantastic. Surprisingly good employment numbers coming out. We've replaced all of the jobs that were eliminated through the Great Recession and moved on to new highs. Clearly that's not the case in the United States, but it's getting there. It's moving along, and it's moving along by the right people. The private sector. Right? Private sector jobs are what we really need. We don't necessarily need the government hiring people just for the sake of it, and they're not. So it's good to see that most of the job creation that has happened over the last 2.5 years has been born out of the private sector. Right? So that certainly is something that's very healthy. One caution though. The unemployment rate is a bit of a funny statistic because it's got two moving pieces to it. It is not the number of people in the whole economy that are unemployed. It is simply the number of people in the whole economy who wish to work, who would like to work, that are unemployed. And the number of people who would like to work is measured by this thing called the participation rate. And that's our blue line here. So I can get a lower unemployment rate simply because people give up looking for work, sit at home and watch The Price is Right. Is that going to help grow my economy? Is that a good thing? Obviously not. And this, unfortunately, both in the United States and in Canada, much more stark in the US, because this participation rate, the number of people who would like to participate in the labor force, is at a 35-year low, 63.2%. So this tapering thing where the firemen are going to turn off the hoses and roll them up and put them back in the truck, and hopefully the economy can stand on its own 2 feet, is predicated on the unemployment rate. Central bankers in the United States have come out on the record and said, we're not going to stop pumping and printing money until we see the unemployment rate get to a certain level, 6.5%. I would argue that that 6.5% is a fuzzy number. Because if we get to 6.5% on the back of more people sitting at home watching The Price is Right, then that's not an unemployment rate that the Federal Reserve in the United States is going to be happy with. And they will continue to print money. All right, so you need to be careful about, is it job creation that's bringing my unemployment rate down, or is it people giving up looking for work? Right? It's a bit of both at the moment, and the relationship between the two matters. If I'm going to spend money, how much I have currently borrowed is certainly going to figure into my decision to go out and buy a new car or a new washing machine, etc. And we've certainly seen the balance sheet of U.S. households, and we put the U.K. on here as well, has improved dramatically. When you go bankrupt and you file for foreclosure on your mortgage, this moves this line down. That's not the way you want it to move down, but the net result is the same. Joe Sixpack does have more money in his jeans to go and shop at Home Depot if he's not paying his mortgage. Right? Who's got the mortgage problem? Well, they gave it to the government, which is part of our deficit and debt problem in the United States. We have been beat over the head by our Prime Minister and Jim Flaherty and certainly the Bank of Canada about the profligate drunken sailor borrowing that Canadians are up to. This is an issue, but there's two pieces to whether or not borrowing is a problem. The first is, if I'm borrowing but I've got assets on the other side against that borrowing, that's not as bad than if I just borrow and blow it on a vacation or a depreciating asset like a big screen TV. But if I've got a house, then that certainly is a better place to be. And much of this debt, as we know, is in the Canadian housing market. And the other is if I can afford that debt, afford to pay it, afford to service it, then I don't need to be as concerned either. That's the second piece that we don't hear as much about in the media. The concern on the part of politicians is if or when we get to an environment where interest rates are a bit higher than they are today, is all this borrowing that Canadians have done going to become a problem? And certainly if interest rates were to go up dramatically, it would be. We're not in the camp that we're going to see interest rates going up dramatically. They're going to probably head higher, but let's keep that in a context, and we'll talk a bit more about that in a few minutes. All this is borne out when we look at sales activity. So retail sales in the United States, I put good with a bit of a question mark, because a line that goes up and to the right is usually comes with a good number, and that one's just nosedived. It's nosedived because of dysfunction in Washington, largely. All right? The Canadian number, I put bad on there because it's below the US number, but it's actually trending up a little bit, and this is certainly good news. Right? This is the housing slowdown hitting this sort of magical soft landing, which it pains me to say, but it does appear that that is what has happened. Right? It's decent wage growth in Canada, it's low inflation in Canada, and it's decent employment growth in Canada that is allowing the Canadian consumer to continue to spend. I mentioned household net worth. Americans have never been wealthier. $70.3 trillion of net worth in the United States amongst just the households. That doesn't include what businesses are sitting on. So we think about debt and deficits on the government side of the ledger, right? And they're large and they're a problem for sure, right? But we do need to put them in the context of the sheer magnitude of the US economy. And small changes can have a massive impact. And we have a great experience with this as Canadians. Most folks in this room will remember when we were basically Greece in 1992, and we had runaway inflation and high interest rates, and the rest of the world didn't want to lend us any money because they thought we were going bankrupt. And what did we get for it? We got high taxes, we got government austerity, and we got the GST. Those are the three things that the US needs to address. Imagine what even a small 1%, 2% value-added tax like a GST, and I'm not a big tax guy, trust me, but if you've fought all these wars and you've got all these bills to pay, you've got to do something. And it is the only country on the planet where you can drink the water that comes out of the tap that doesn't have a national value-added tax. And if they don't do it now, and they continue to kick the problem down the road, then they won't be able to get away with a 1 or 2% value-added tax. They'll have to do something like 5 or 7, like we did. Right? But it does work. On the manufacturing side, things look fantastic. So this is a survey where 50 is the magic number. If it's above 50, things are good, and if it's below 50, things are not so good. So if we're above 50, we call it this is expanding. Businesses are growing and hiring, and their view of the future looks really good. And if you're below 50, then businesses are saying, you know what, I'm going to lay a few people off, and things don't look so great. For the first time since the financial crisis, we have all of the major powerhouse economic regions in the world above 50. And this is fantastic news. Exports. So we think a lot about China when it comes to resources and commodities. Commodities by definition is the same thing. So it should trade at the same price. And the person who sets that price for everybody else is the next person who needs to buy that thing more than anybody else. Whether it is cement or iron ore or oil, right? And China, in many aspects here, is the next people who need to buy this item as they're growing substantially. So for a country like Canada and China's impact on commodity prices, it's important. Yet we don't do a lot of trade with China, believe it or not. 70% of all the trade that we do continues to go north-south. Right? So both of these things certainly have an impact, but the U.S. still continues to be our greater impact. This is something that we're trying to change as Canadians. We'd like to see more East-West trade. The EU Free Trade Agreement that was announced recently between Canada and the European Union is a move toward trying to diversify ourselves away from having one customer, which is always a good thing. Diversification in your portfolio is a great thing. Diversification in your economy is a great thing. All right? The thing with China is we certainly went from reasonable to bad. Right? Now, the big dip, obviously, that's the recession and was global, and that affected everybody. So that's certainly understandable. Then China spends a whole boatload of money to try and get its economy stimulated again, and that works. One of the things that you're supposed to get when you print this money to try and spur on the economy is you're supposed to get inflation. And China is the only place in the world where that actually relationship has held up normal. They did get inflation. So inflation back here in the 09 and 2010 period is running too hot for the Chinese authorities. And they take steps to cool the economy, and it gets us into bad territory if you're a Canadian. The problem that the Chinese faced at that juncture is their single largest trading partner in and around that time happened to be Europe, just by a small margin larger than the United States. And Europe at that juncture gets into its trouble and goes down the berry hole. Got my buttons mixed up, there we go. And we go from bad to ugly. Now, when you're talking about an economy that has been growing double digits for 15 or 20 years, from what was a fairly small base in terms of measurable economic activity, to now being, by some measures, the second or third largest economy on the planet, to continue to grow at a 10 or 12 or 14% rate is not necessarily what you want. That's my Goldilocks. Too hot, no, not so hot, and just right. And what we would like to see, even as Canadians where we have a lot of commodities to sell the world, is a China that's a little bit more stable than this stop-start experience that we've had as of late. And it does appear as though that's coming to fruition. A little more modest, moderate growth rate. Now, 7.5%, we in the Western world give our eye teeth for that kind of growth. We're looking at 2%. All right, so again, let's keep things into perspective. Still a lot of demand coming out of China. But as I mentioned, we don't sell a whole pile of stuff to China. We sell it to the U.S. And this is the good old salad days where we are selling more to the rest of the world than we are buying. That's wonderful. Your currency goes from 50 cents to $1. All right, we all get jobs and make money, and things are wonderful, wonderful Canada. Then we go down the berry hole with the rest of the world in the financial crisis. We're a trading nation. This is understandable. It's painful and it's ugly, but we understand it, right? And then things start to improve, and we move out of the Great Recession until we hit a bit of a speed bump. And this is where it's ugly, because this is not the relationship that we've signed up for as Canadians for the better part of 150 to 175 years. Recall that we were talking about the U.S. housing market improving, the U.S. economy improving. In fact, the automotive sector has been one of the areas that has improved dramatically in the United States. Key for this part of the world, for sure. And yet we're seeing our exports floundering. That's puzzling as Canadians. This isn't the way it's supposed to be. If the U.S. is getting better, we're supposed to come along right with them. So there's certainly some reasons for this. One that's been pointed to is this, for sure. Manufacturing in Ontario and Quebec is having a more difficult time competing against low wages in Lansing, Michigan, and in Tennessee, and in Texas. All right? Texas now makes more automobiles than Ontario does for the first time ever. This is a problem. Some of it is to do with the high dollar. Some of it is to do with productivity. Some of it is to do with the fact that the UAW apologize if there's any auto workers in here, has taken bigger wage concessions than the CAW, UAW being the U.S. Auto Workers Union. And not only wage concessions, but they're thinking a bit differently about how they want to engage with the employer. So the UAW has said, we will be in a profit-sharing arrangement. The company does well, we'll do well. I'm sure many of you are familiar with that. CAW has said, no, we still think it's 1977. We want a flat wage, we want flat benefits, and we don't want to have any of this flexible stuff. Right? If you're an automaker and your decision is to build it in Brampton or Oshawa or Oakville or Windsor versus Lansing, Michigan, Flint, etc., these things matter. All right? So it's not just about the Canadian dollar. The other thing is energy. It may surprise you to learn that we are the single largest exporter of energy to the United States, and all of our energy goes to the United States, pretty much. We don't sell really 1 barrel of oil to China yet, and these are certainly things that we need to address as Canadians. This is West Texas Intermediate, WTI. This is the oil price that you will see in the media every single day. And at $150, even for a country like Canada that has gobs of oil, this is a bad thing. People can't afford to buy it. $150 oil starts to have people park their cars in their driveways. In 2008, for the first time since the proliferation of the automobile post-Second World War, Americans drove less Memorial Day weekend in 2008 because it was too bloody expensive. At, ugly, $35. Well, the marginal cost to get out of the ground in Alberta is above $35, so you can't make money if you're only selling it for $35. But we now have a period where, compared to where we came from, and I know it doesn't feel this way necessarily when we look at the pump prices we drive by every day, we have actually had reasonable stability for energy prices. And that's a good thing for businesses to be able to plan for spending. These are American oil prices, however, and as much as it's the number we quote in Canada every day, it really isn't the number that matters to us as Canadians. That's this number. WCS is Western Canada Select. This is the oil that comes out of Alberta. Right? And there's a price differential between WCS and Western Texas Intermediate. Some of it is because the quality and the oil is a little bit different. Let's say that's $10, which it's around that is what it had been. Well, things were fine at $10. So if you're getting $100 for WTI, you were getting $90 for Canadian oil. And then it gets bad. And then it got good again. And then it got bad again. And then it got good again. And then it got bad. And then it got really ugly. Oil in North America, WTI, was $90 a barrel. Late last year, we were getting $45 a barrel. Why? The U.S. knows we don't sell it to anybody else. One of the reasons, we have one customer. They can set the price. And even if they wanted to buy more from us, we couldn't get it to them. Right? This is the whole pipeline issue that we're faced with. But when we talk about GDP growth, and certainly we're back to ugly again, business investment is a big part of that. Remember the formula, C plus I plus G plus X minus M. One of the pieces was businesses. How much are businesses spending? Well, whether Loblaws opens a new shop or Hudson's Bay does something is not going to necessarily move the needle big time on business investment in Canada when you look at it in total. For the last 15 years, we have been doing tens of billions of dollars of business investment in one place, Alberta. And that's been a big chunk of economic growth. If you can't figure out what you're going to sell your product for, because it's, I don't care what the discount is, it's the variability in the discount that's causing havoc, then projects like the Crude upgrader that was canceled last year continue to get canceled. Right? And this is largely born out of a transportation issue. That's why we saw oil by rail. And we now unfortunately know, the poor folks in Lac Mégantic, that is not safer than oil by pipe. Right? Issues that we need to face. Some of it also is the Americans don't need as much of our oil. So this is, I'm a big fan of National Geographic. We don't take our investment research from National Geographic, rest assured. Right? But I just found this interesting that 2004, the end of cheap oil. Jeff Rubin, who I worked with at the time, ruined his career by making this statement. Oil prices were going to double. They were already $100 a barrel. They were supposed to go to $250 in his estimation. We saw where they went, $25. Jeff's now an environmentalist. All right, if you have seen him as of late, just change your argument to fit your story, maybe. I shouldn't pick on Jeff. He's a smart fellow. And this is March of this year. America strikes oil. Wait a second, we just thought America was running out of oil. So where do we get our investment research? We get it from data like this. And if you've not seen this chart, and most folks haven't, I almost fell out of my chair when I saw this. This is shocking. And it's not good, bad, or ugly, it's just reality. In fact, on some respects, for the globe, for the world, it's a pretty good thing. For Canadians, it could be fine if we figure out our story. So this is back to the year I was born, 1970. And it certainly looked like Jeff Rubin had an easy time to say, America's running out of oil. This is the amount of oil that the U.S. produces itself. Right? We forgot that the U.S. started as an oil superpower. Right? That's how they built their economy for 100 years. And then it looked like it was all over. And now look what's happened. We've erased decades. We probably wouldn't have had Gulf War 1, 2, 3, 4, etc. if this had happened 30 years ago. And it's because of technological innovation. This is why I believe so firmly in investing in stocks. Technological innovation put the buggy whip industry out of business and born something else. Right? From ugly is born all things good. Because of fracking technology, we've been able to discover and get at oil in North America that we never thought we would get to. Here's the math. This is kind of neat. The U.S. consumes 18 million barrels of oil a day. 18 million barrels of oil a day. You get about 40 gallons of oil from a barrel. That's a lot. They were producing 6, 7, 8 million barrels a day 5 or 7 years ago, and importing 12. They imported about 3 from us, 2 from Saudi Arabia, then you have Iraq, Iraq, Mexico, then Venezuela. 5 largest suppliers of energy, of oil to the United States in terms of imports. Canada's number 1, and we're almost twice as big as Saudi Arabia. So rhetoric from the United States that says, hey, we're not going to buy oil because it's dirty. Did you look at the numbers? Who are you going to get it from? Because Mexican oil is just as dirty as ours, and so is Venezuela. And last time I checked, sending money to countries who don't like you very much to buy their oil hasn't worked out all that well either. So here's the new math, however. If let's, for argument's sake, Tesla and electric cars and efficiency and natural gas and all these things that are wonderful things, and they only still consume 18 million barrels a day as we move forward, right? Just as an argument. And they go from needing 12 imported, but then they've doubled their production, so now they're producing 12. They only need to import 8. That billions and billions and billions of dollars we've been putting into Alberta for the last 15 years, we're soon going to be able to give them 6. They do 12, we give them 6, that's 18. That's North American energy independence. A concept that not that long ago seemed pie in the sky crazy talk. It's pretty close. And imagine what that would do for the world. Amazing. But we need to be able to get it to them. Because if we can't get it to them, whether we can give them 6 or not isn't going to matter. Right? This is why pipelines and our infrastructure is so important. Get off my soapbox here. Natural gas. There is nowhere else in the world that is as cheap to have natural gas as it is in North America. It's gone from $7 all the way down to almost $1, and we're sitting in around the $3.50 range. If you want to sell it to Tokyo, it's a little bit, it's better on your screen. You get $13, $14 for it in Tokyo. $3.50 here. There's $10 that we can share between the First Nations, the British Columbians, and the Albertans, and Ottawa, and everybody, if we can all figure out how to do this. Now, we got to build a facility to liquefy it and ship it and unliquefy it over there. Natural gas doesn't travel very well. Right? That's the problem. It's most useful where you find it. The good news for America, part of why they could become an exporting nation again, part of why they're seeing a manufacturing renaissance. You may have heard of reshoring. These jobs are coming back to the U.S. that used to be shipped overseas. Part of that is because a lot of this natural gas is right beside the industrial heartland of the U.S. It's in Pennsylvania and Ohio and New York State. And again, it's technological innovation that has inspired this. So for all of the problems that we see in the United States and Washington, U.S. corporations and U.S. consumers are getting out of bed in the morning, putting their pants on, and going and getting things done. Slowly, 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 it is healing. For Canadians, natural gas, big deal. Here's 2 stocks that we own in our dividend fund. And you'd think that low natural gas prices would be a problem, and for most natural gas companies they are. Right? But here's an example of one that takes natural gas and makes stuff out of it, Methanex. Right? Great Vancouver company. As you can see what it's done for its share price. This is an example of reshoring. Methanex had a facility in South America. They closed it, opened up 2 new facilities in Louisiana, just outside New Orleans. A place I'm pretty sure could use some jobs. That's reshoring. Right? On the back of what seemed like a negative, low natural gas prices. Even for companies that make natural gas, it doesn't have to be all bad news. Peyto Exploration is the world's lowest cost producer of natural gas. So even when it was at $3, they still made money. Right? It goes back up to $5, they're going to make even more money. So we need to look behind the headlines and we need to do our research. Right? And that's what we do as active investment managers, to try and find out what does it really mean for these companies? And are they going to be able to thrive or not? So let's look at markets a little bit. I talked in the intro, and the way this was built is we have seen markets take a lot of this information and digest it. Right? What we've talked about so far has been history. And markets are forward-looking animals, remember? So we're trying to figure out what's going to happen over the next 6, 8, 10, 12 months. And they've priced in a lot of this good news. Which is good because there has been plenty of good news, considering where we came from. Canadian market has lagged considerably against the US market for the past 2 years. The media and others are starting to pick up on this fact. Some of it is simply the nature of our market. Canada is a very sector-specific place to invest. And it comes back to when you're having conversations with the folks at Langlois Financial, and they talk to you about being diversified and talk to you about looking at opportunities outside of our borders, it's because we're saddled with a little bit of a legacy. So 3 sectors: energy, financials, and material. Materials is gold and pulp and paper, actually, and rocks and trees and that sort of stuff is in the material space. Potash. That makes up 70% of our market. 70% is in those 3 places. Look at the US market. 1, 2, 3, 5 sectors before I even get to 60-odd%. Much more diversified. And there's only one that overlaps, financials. And I would argue even that's massively different. 6 big banks in Canada and 3 insurance companies. Financials in the United States is hundreds of companies. But what about valuations? No doubt heard, the media has trumpeted that markets are back. We've made new all-time highs in the US. Our Canadian market, unfortunately, has a ways to go before that happens here. But in the United States, it certainly has already happened. Right? But does that mean that I missed it? Hopefully, you've been investing all through the piece. Does that mean I need to sell everything now? We're back to the peak and it's time for it to crash again? Well, here's 2 numbers that hopefully will convince you that this represents something real. So there are 500 companies in the S&P 500. It's aptly named. If you combine the profits of all of those 500 companies, back in 2007, that was $1.5 trillion. So this level of the stock market represented, in theory, what it would cost me to buy all 500 of those companies. And what am I owning? I'm owning $1.5 trillion in profits. Why does that matter? Well, today, same price to buy all those 500 companies, yet I get 32% more profits, $1.9 trillion. So it shouldn't be a surprise that equity markets are making these new highs. There's good reason for it. They're worth more. So don't be afraid. A little bit about fixed income, and then I'll wrap up. Good, bad, and ugly. When I mentioned at the beginning, if you look down that list of investment returns, you see cash and money market and bonds and Canadian stocks. One of the areas that's going to look pretty rosy, not recently, but certainly if you look at 5, 7, 10 years, is going to be your fixed income area. And certainly we're big believers that fixed income plays an important role in people's portfolios, but we need to be mindful of what it can do for us and what it can't do for us. All right? So, this is a case where we maybe have had too much of a good thing. If we've grown accustomed to reasonably safe, secure, in perception at least, bonds giving us 6 and 7 and 8% year after year after year after year, those days are over. That's not my opinion, that's mathematics. And I'll show you why. The way that you get returns out of bonds, see, I was hoping I was kidding. Thank you, Daryl's got my back. The gray bars is the total return you got from bonds in that year. It's made up of two pieces. The blue bar, how much income, the coupons that I get from my bonds, how much was that? Well, we can see the blue bar is half of what it used to be at 2.3. So if nothing changes, that's what I'm going to get from my bonds. We know this, the 1st of January every year, we can simply look at all the bonds in the marketplace and say, what would they pay us if they all paid their coupons? And that's the number. All right? That's why the question mark is, we don't know what we're going to end up as a total return. Because the gray bar comes if interest rates change. And if interest rates fall, you get gray bar. All right? And if interest rates rise, gray bar goes away and in fact eats into your blue bar. And it has eaten into your blue bar this year beyond zero. In fact, you've had negative numbers. Because interest rates have gone up this year. This is a 10-year government of Canada bond yield. And the line moving up means interest rates have gone up. And this is what it has done for fixed income returns. All right? It's a bit painful. But it is short-term in nature. Higher interest rates are going to be a reflection, hopefully, of an improving economy. That's why rates are moving higher. This is why you need to have some equities in your portfolio. Because offsetting that has been anywhere from 7% returns in Canada so far this year in stocks to the mid to high 20s in US stocks this year. This is where the balance comes from. We will get to a point at some time when we're back to 4 or 5% bond yields. Right? And that will be a place where savers are more properly rewarded for parting with their hard-earned money and giving it to a government or a corporation as a loan. What we have at the moment is artificially low interest rates on the back of a lot of fear on the part of investors and a bit of complacency perhaps because we've had 10 years of 6s and 7s and 8s and the government doing all this money printing. Right? Many of those things we think are going to change as we move forward. Unfortunately, the main three things you look at to build your portfolio are cash, bonds, and stocks. And yet, the thing that looks the most ugly and has been the most painful for us over the last 10 years is stocks. The area that we think has got the greatest opportunity to help you move forward with your financial goals in the next 7 to 10 years is stocks. Because you have to look to ugly in order to find opportunity. Be cautious of all things extremely popular and good. You don't want to be the last person to the party buying something that looks like it's done fantastic. Right? It's already been baked into the price. Bad is just usually a necessary adjustment to things becoming overpopular. And markets will overswing. They're fraught with emotions. They're the culmination of all of us as human beings. And we're emotional, irrational people. Particularly when it comes to investing most often. Right? But ugly is where opportunity is born. Remember the duckling. Thanks so much for your time. I'll be around afterward if you have any questions. I'm turning it back to Ryan, I think.